Last week we discussed what makes gold-heavy allocations so dependable, and there were a few conclusions that we arrived at. First, gold-heavy investing strategies seem to give you some additional protection against inflationary conditions, such as what we saw during much of the 1970s and early 1980s. Second, the returns of gold were not highly correlated with stocks or bonds, which gave you some added stability to otherwise turbulent times. Third, the money we put into gold had to come from somewhere in the allocation, and that somewhere usually ended up being stocks, which tend to be a little bit more volatile than gold in the short term under most circumstances. And as a result, by holding more gold and less stocks, we were usually holding less of our most volatile asset. And fourth, for much of the 20th century, the value of gold was artificially held constant, which obviously helped those consistency and dependability metrics during those years. Although in recent years this hasn't been a thing, so clearly it wasn't the main reason for the dependability of gold-heavy strategies. However, not everyone wants to hold a lot of gold, or maybe any gold for that matter. And I can completely understand where people are coming from with that. Gold is not an income-producing asset, and it can, and has, gone literal decades without appreciating in value in real terms before. To give you an idea of what I'm talking about here, on an inflation-adjusted basis, we're still waiting for gold to break its all-time highs that were set in early 1980. So that raises the question, are there any strategies that seek to produce those highly dependable, though maybe not extraordinarily high returns, without investing in gold, or some other asset that presents largely the same issues? Well, as it turns out, there is, and it's the subject of today's video. Let's talk about Frank Armstrong's Ideal Index portfolio. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The Ideal Index portfolio has you split your money up into 7 different investments. 6.25% of your money goes into a large cap, blend, and small cap growth fund. 9.25% of your money goes into a large cap value fund and a small cap value fund. 31% of your money goes into an international stock fund. 30% of your money goes into short-term treasuries, and the final 8% goes towards real estate in the form of REITs. So we've got 31% of our money going towards various US stocks, 31% towards international stocks, 30% towards bonds, and the remaining 8% towards real estate. As I said, the thing that separates the Ideal Index portfolio from many of the other strategies we've covered so far in this series is its ability to be pretty darn dependable without investing any of its money into gold. But it's always nice to see an allocation that does that without putting all of its eggs in the basket of one country. With that being said, let's get started with the analysis. As usual, we'll start by analyzing the portfolio's historical returns. To analyze the returns, we'll be looking at several different metrics. The short and long-term inflation-adjusted returns for every starting year since 1970, though I should note my data on REITs only goes back to 1972, so what I'm going to be doing is split the 8% that would normally be going towards real estate with this strategy proportionally into all the other assets in 1970 and 1971. Normally I'd only go back as far as I have data on all the assets in the strategy, but given that we're only missing 2 years here and it's for an asset that takes up a very small portion of the allocation, I don't anticipate it making too much of a difference in the final results. And I do like to see how strategies handle themselves during major market downturns and inflationary periods, which is what we did have in the early 1970s. We'll also be looking at the risk-adjusted returns, how often the portfolio loses money on an inflation-adjusted basis and how severe those losses were, and how dependable the strategy was based on how sensitive their long-term returns were to when you decided to start investing. So based on the data I have since 1970, the average 40-year inflation-adjusted return for the Ideal Index portfolio is about 6.2% per year. The best and worst case scenarios saw long-term real returns of 7% and 5.2% respectively. That suggests that a $10,000 investment would grow to an inflation-adjusted value somewhere between $76,000 and $150,000 over 40 years, with the average being around $111,000. In any given year, the returns have been as high as 27% or as low as negative 26%. On average, they hover around 5.7%. The Sharpe and Sortino ratios for this strategy were 0.48 and 0.66 respectively. That's the 5th-ranked Sharpe and 7th-ranked Sortino ratio among the strategies we've covered so far, suggesting that its overall risk-adjusted returns are somewhere around the middle of the pack compared to the other strategies we've covered during this period. But its downside risk-adjusted returns are a little bit below average, which is not too great for a strategy that's trying to be consistent and dependable, but if we compare it to just the other strategies that don't invest anything into gold, it beats everything except for the classic 60-40 strategy strategy and the comeback portfolio in overall risk-adjusted returns. And in terms of downside risk-adjusted returns, it beats everything except for those two and the no-brainer strategy. With that being said, now let's take a look at some volatility metrics. The average standard deviation of returns for the ideal index approach was 11.5%, which means that in any given year, we can expect that most of our returns will fall somewhere between negative 5.3% and 17.7% with this strategy. The strategy had an excess kurtosis value of negative 2.16, suggesting that the majority of its returns were within a few standard deviations of our average. Roughly 73% of the returns during these years fell within the expected range. Only 8 of them fell outside of that range for the worse. The strategy had a skewness of negative 0.69, suggesting that the majority of its returns would actually be above the long-term average, with a few returns coming in significantly below that average, dragging it down. And as we see in the loss figures, that does appear to be the case. There were a total of 14 years, out of a possible 52, where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 27%. Of those losses, 5 fell by at least 10% and 2 by at least 20%. Thankfully, most of those downturns were recovered from relatively quickly, as there wasn't a single 10-year stretch where the strategy failed to keep pace with inflation. The closest it came was the 10-year stretch ending in 1983, where it beat inflation by 1% per year. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy's returns have been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperformance and the largest overperformance, as low as possible. The ideal index portfolio had a total start date sensitivity of 14.5% during this time frame. The largest overperformance was 9.4%, which took place from 1982 to 92, and in those years, the ideal index strategy had an inflation-adjusted return of 10.6% per year, beating out the returns from 1972 to 82 of 1.2% per year. The largest underperformance was negative 5.1%, when the returns from 1999 to 2009 failed to match the returns produced from 1989 to 1999. On average, its start date sensitivity hovered around 3.5%. Now that isn't quite as strong as we've seen from some of our gold-heavy portfolios, but it is the best mark we've seen in either metric of any of the strategies that didn't invest any money into gold. The no-brainer strategy comes close with a total start date sensitivity of 17.8% and an average of 3.8%, but no other approach managed a total start date sensitivity figure below 23%. So I'd say that for a strategy that's primarily attempting to be dependable over the long haul for someone who isn't wanting to invest any money into gold, that's pretty darn good. But that just about wraps up our analysis of the strategy's returns. Now let's move on to our crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at several different metrics when analyzing the crashes. They are the depth of the crashes, how long it took for the portfolio to bottom out, how much the strategy rose and fell relative to the rest of the market, how much of its time was spent in either crash or correction territory, how strong and sustainable its rebounds were when they came, how long it took for the strategy to set new all-time highs, and the Ulcer Index, which seeks to give investors a better idea of what the investing experience will be like by considering both the depth and duration of downturns. For the ideal index portfolio, the deepest and longest inflation-adjusted crash took place from 1973 to 1980, when it trailed inflation by over 36% at its worst. Other notable downturns like the dot-com crash and Great Recession were not as bad, lasting for 3 and 4 years respectively and falling around 16 and 26%. The average downturn saw the ideal index portfolio fall 12.7% from previous highs, with a downside deviation of 8.9%, suggesting that the majority of downturns would see drops between 3.8 and 21.6% once they bottomed out. On average, it takes around 4 months for the portfolio to bottom out. This gives it a dive rate, or the amount the portfolio would fall in an average downturn if it continued falling at that same rate for a full year, of 38%. In the year immediately after bottoming out, the ideal index portfolio had minimum, average, and maximum rebound intensities of 5, 15.8, and 24.4%. If we filter those results to only look at how it bounced back following major market crashes, we see that it jumped about 20% in the year following a market bottom in both cases. To get an idea of its longer-term resiliency, we can look at what I call the portfolio's comeback magnitude, which measures how much the portfolio grows each year on average between bottoming out and setting new highs. In this case, the ideal index portfolio's comeback magnitude was 7.7% per year. On average, it took a little over a year and 10 months for the ideal index portfolio to set new highs after bottoming out. This means that, on average, downturns lasted roughly 2 years and 2 months for this strategy. It spent 18% of its time in correction territory and 6% of its time in crash territory. And its downside capture ratio, which measures how far the portfolio falls relative to a benchmark in the months that the portfolio itself was falling, is 96 when measured against the total stock market, suggesting that when this strategy falls, it does so a little bit less than the market as a whole. Although when the portfolio was rising, it was doing so at a slower rate than the overall market, scoring an upside capture ratio of just 39. This makes its overall capture ratio 41, suggesting that its strong downside protection was not quite enough to make up for its lackluster upside performance relative to the overall US stock market. So in the end, what we've got is a portfolio that trails inflation less frequently than almost any other, with only the golden butterfly trailing inflation less frequently than this one, though it isn't quite as good at capping its losses in the single digits as some of the more conservative allocations like the permanent portfolio or the golden butterfly. And when it does bounce back from downturns, it tends to do so in a stronger way than many of those gold-heavy allocations. But its strongest rebounds do fall short of some of the more aggressive all-stock strategies, as we would expect. This vacillating between pros and cons is reflected in the strategy's middle-of-the-road scores in the ULSR index, which rose to as high as 1.2 during these years and on average hovered around 0.5. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the ideal index strategy would have maintained minimum 30, 40, and 50-year safe withdrawal rates of 4.64%, 4.33%, and 4.14% during this time period. The worst year to retire using this strategy was 1970, as that's when all these minimums were set. And I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 7.64, 6.66, and 4.44% for the 30, 40, and 50-year scenarios, respectively. And the maximum rates for the same durations were 9.42% set in 1983, 8.25% set in 1981, and 4.74% set in 1971. The strategy would have maintained a minimum perpetual withdrawal rate of 3.82%. And as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original inflation-adjusted principal by the end of the dataset. In terms of income during financial independence, the Ideal Index portfolio generated an average of roughly $147,200 per year on a $1 million nest egg among all available 30-year cycles. The median income was a bit above that at around $148,300. Over the first 5 years of financial independence, those figures clocked in at around $83,700 a year, with income rising in roughly 99% of all years. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here are what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Assuming that we save 15% of our income, we're planning for a 30-year retirement, and our expenses change in line with inflation as measured by the CPI, we would not yet have achieved financial independence. However, with a 30% savings rate, we would have reached our goal in 8 of the 52 scenarios. On average, it took about 41.5 years to reach FI, with the fastest taking 38 years, starting in 1982 or 83, and the slowest taking 46 years, starting in 1975. With a 50% savings rate, a hypothetical investor would have reached financial independence in 34 of the 52 scenarios. On average, it took about 19 years to reach FI, with the fastest taking 15 years, starting in any year from 1982 to 85, and the slowest taking 26 years, starting in 1970. And finally, with a 70% savings rate, the numbers improved still further, with a hypothetical investor reaching financial independence in 45 of the 52 scenarios. On average, it took about 8.5 years to do so, with the fastest being 5 years, starting in 1982, and the slowest being 16 years, starting in 1970. The last metric I like to check under the financial independence banner is the strategy's scalability. When I say scalability, I'm referring to the strategy's ability to scale up or increase its minimum safe withdrawal rates and or FI income metrics when we incorporate drawdown maximization techniques such as cash buffers, financial guardrails, and flexible spending budgets. The more scalable a strategy is, the larger the benefit we'll see in these metrics as more of these techniques are used. I reran all the simulations for the Ideal Index portfolio, assuming that we use financial guardrails with a 10% adjustment to the projected withdrawal if we ever fall outside of the upper or lower guardrails, which I set to be 20% above or below whatever our initial withdrawal rate happened to be, a spending floor of $30,000 a year, which we're not allowed to go below regardless of what the guardrails say to do unless our investments have fallen enough for our flexible spending budget to kick in, a flexible spending budget of $24,000 a year, which we'll only use in years where the value of our portfolio has fallen by at least 20% from its all-time highs, and a 2-year emergency cash buffer earning 2% interest, which in this case means we would have $48,000 in cash on the sidelines since since our emergency spending budget is $24,000 a year. Similar to the flexible spending budget, we'll only use this cash when our portfolio has fallen at least 20% from all-time highs. Here's how the numbers came out. As you can see, there's quite a jump across the board for safe withdrawal rates. This also leads to a sizable difference in our accumulation metrics. Here's how the approaches compare with one another at different savings rates. A somewhat different story can be told for the income metrics. For the most part, the income figures for the early stage of financial independence looks like an improvement, but due to the fact that our guardrails would have us slash our incomes more often than before, the overall figures do take a step down. Comparing the Ideal Index portfolio to all other strategies we've covered since 1976, as that's the earliest year for which I have data on all the investments available, we see that its story stays largely the same. It does trail the Larry portfolio in terms of overall dependability, but not by too much, and it does come with superior long-term returns, 6.7% per year adjusting for inflation versus 5.9%. As I said, it isn't the highest returning strategy, it's more middle of the pack, and it isn't the most tranquil or resilient approach, again, more like middle of the pack, but what it is a pretty consistent and dependable strategy that fills the niche for those investors who don't want to put so much money into gold. It isn't the only strategy that can fill that niche, of course. I mean, the Larry portfolio has been the most dependable goldless strategy we've covered so far, at least since 1976. The no-brainer portfolio and classic 60-40 strategy also put in some good showings in the consistency metrics, and they carried slightly higher overall long-term returns, but the classic 60-40 approach didn't diversify much internationally, and both were a tier below the Ideal Index portfolio in terms of start date sensitivity. So on the whole, you could argue that it gives you the best blend of reasonable returns, consistency, and dependability, at least among the strategies we've covered so far, that don't invest in gold. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.